All right, sweet. So you've got condors, you've got your straddles, and your basic options. You are absolutely on fire. Now we're gonna look at the butterfly setup. And this one's pretty interesting. This is a long butterfly, and if it looks kind of crazy, it's because it's kind of crazy. What you're doing here is you're gonna buy a call at both of these points right here, and then sell two calls at the top right here. And that's, of course, at this strike price right in the middle. And the goal with it is just like the last two we looked at, it stays in the same trading range and you make a bunch of money because the stock doesn't move. It's a pretty ballsy play. So basically what you're doing is you're just selling both of the calls at the same price instead of selling like a call and a put, or instead of spreading out the call and the put. All you do is sell two calls at the same price, and then you buy two calls here to limit your downside. Um, it's sort of like the trades that we're just looking at earlier. Same application as the trades we're looking at earlier. It's just a little bit of a tighter range and a freaking ridiculously crazy risk-reward ratio. But the cool thing is you do get a little bit of reward, a little bit more reward. So here we have $3 signs up here and two scientific dollar signs down here. So just a little bit more upside. If I was gonna show you, this is sort of like downside. You get a little bit more upside with this. So it's a lot better than the Iron Condor in terms of the amount of money that you can make, but it's also a much tighter period of the price range. So you've got to be more accurate, and if you are more accurate, you can make more money with it, which is sick. That's the point, right? With that said, there's also the short butterfly. Very similar concept. You sell a put here, you sell a put here, and you buy two puts here. So it's basically just flipped. And the goal with this one is actually the opposite of the long butterfly. You want it to just go absolutely berserk. It's kind of like just like a long straddle. Basically, at the same point, instead of a put and a call, you would just buy two puts at this price right here, and you're selling puts here. So it just makes it so basically you've got upside and downside volatility accounted for, and you're going to have profit as long as the stock closes away from the center point. So it's basically just a more complex way to do that straddle or the long straddle where you're trading it on the volatility and you want to see a really, really big movement away from the center. And if you just put these orders in at the same point, it's going to give you, again, a more expensive order. You can see my scientific $3 signs here. It means it's a little bit more pricey because you are buying four options. Your upside only has $2 signs. So again, not necessarily the best trade for risk reward ratio. You look at the set, I mean, you're looking at, a pretty decent amount more risk than the reward you're going for here. But if you're confident about the trade, the stock's going to move a lot. You can kind of compare and contrast, but it's usually just a lot simpler to use normal options in some of the straddle sets we talked about earlier. And because butterflies, they're just kind of like crazy, crazy, crazy spreads that are kind of tough to work with because they do have a very, very tight trading range compared to the normal straddles. And so because of that, it's kind of tough to do. So I would recommend using, at least for most investments, using those basic calls, basic puts, and then the straddle for like earning stuff. And then if you want also the short straddle for your longer term investments, your bond fund stuff like that, where you want to squeeze a little bit more out of it, but you don't necessarily just want to sell a call every time it hits a resistance or sell a put every time it hits a support. That's a pretty powerful strategy that I kind of prefer, and it's based more on technical analysis, and it's based on the idea that when it hits here, you can sell a put, when it hits here, you can sell a call, when it hits here, you can sell a put, over and over and over again, until, of course, it breaks out of the range, and then you have to do something else. So that's just a little bit more based on technical analysis, and obviously using the technical analysis background that we've developed in 9 to Noon, and we're continuing to develop, and you're mastering right now. And so once we get sort of into the technical analysis part, we'll look at pretty much exactly where you would apply these options, pretty much just using puts and calls, which is where most of my trades are made. But again, very, very specialized places where you will see these four options combined together to create a spread, in this case a butterfly spread, and it works pretty freaking well. You know what you're doing, but again, you do have a pretty large risk relative to that reward, so you definitely want to be careful with it, and not necessarily something you're going to use every single day, but you can find a use for it, specifically in situations with a short butterfly where you think it's just going to go berserk, and you can also kind of tighten up the trading range versus a traditional go berserk setup with options. Like with the straddle, it's a little bit wider unless you do them at the same point, but if you do them at the same point, um, it's really, really similar. You just have a little bit more upside on the straddle, so probably recommend that. And then here, it's really just kind of like the same thing as the Iron Condor, except you have a lot more upside with a much more narrow trading range. So for some reason you think a stock's just not going to move, maybe it's a short time period, like just 1 month. That's a pretty solid reason to use this as a way to kind of increase the returns that you would normally get. You're looking at maybe like 5% here. Depends on the company. You can make more. I've seen these guys go higher. But just letting you leverage more returns out of those investments so that you can really grow your portfolio compound faster and then create the real savings and retirement you desire and absolutely crush it. So those are sort of our complex setups for options trades and specifically combining multi-leg setups. Now what we're going to transition over to is technical analysis and implementing options trades into technical analysis, specifically like where to put those calls and put orders in so that you can make the most profit possible using technical analysis and leveraged options that multiply your returns. It's pretty powerful stuff. We've pretty much covered everything that I want to focus on. The only other thing is to make sure, remember we talked about this earlier, the time value of options. It decreases drastically in that last phase of time. So if you are using these like 4 options contract multi-leg setups, you want to make sure that when you sell them, you let them go to execution because you want them to expire out of the money and you want them to expire worthless. But when you're buying them, you probably want to try to kind of time them just a little bit. And again, here you're buying them, you want to time them a little bit and try to get the best price possible for these. Especially, I mean, you're using American options, right? So you can trade them whenever you want. And basically, you know, more on that in the book, but it's just like the normal way that people trade. And so because you can trade these whenever you want, you can kind of try to optimize your profit by selling these when they're, you know, what you think is their peak point. Based on technical analysis, maybe the stock's at its peak point. It's interesting. It's really, really interesting. With the whole implied value thing, I have a couple of options on this one company called One Oak, and like one day their stock went down like 6%, and my options, which expired in 3 months at a price like $10 above the current spot price, they went up like 14%. It was the weirdest thing ever. They were calls. So a lot of times you are going to see some crazy stuff happen with these options. And so something like that happens if, you know, the price of the stock goes down, but your call options increase in value because the marketplace demands them because of increased volatility, increased speculation, or just some other reason why people really wanted those options. Totally don't be afraid to sell these before the end of the position. You can bank a really good profit and protect your downside by having that profit already locked in. It's a really, really powerful strategy and a great way to absolutely make it happen by leveraging, you know, the fact that with most of these multi-leg setups, you're not only selling, but you're also buying. And then obviously, if you're going to do this more actively, definitely make sure you can grab a broker that lets you do naked writing. Make it so like you can sell these options without actually owning the underlying stock, because you probably don't want to own the underlying stock if you think it's going to go absolutely berserk, or if you think it's just going to stay in the same place. If it goes absolutely berserk, you lose a bunch of money, and if it just stays in the same place, especially if it doesn't pay a big dividend, you might just be kind of wasting your time. But if it pays like 5 or 6% dividend, maybe it's cool to own it. But for most of your active management or swing trading, especially with options, you basically, like, I never would trade. I usually, like, very rarely will I trade an option setup or just any options trade on a stock that I already own because I don't really want to get overweight in that stock. I don't want my whole portfolio to be dependent upon the performance of that one stock, especially if it's like a 4 month option swing trade. Like, I'm either in it with options or I'm in it with just normal cash or a normal short position. And options are sick because it's way easier than shorting to just buy a put with most brokers. But and then you don't have to pay like lending fees and you don't pay dividends. I mean, they're really, really, really good because when you buy the put, you're not paying. You know, if the stock has a dividend, you don't have to pay the dividend. You just own the put, and it's like 10 times easier. So we'll talk more about that when we get into the technical analysis part and we look at actually like applying this and getting these assets into our accounts as soon as possible. So really powerful setups here. Hope you guys see the power in them and you're able to use them in interesting moments in time, specifically maybe around earnings reports or with very stable stocks. I love stocks, but stocks. Or if you think stocks are going to go absolutely berserk, definitely a good way. Just make some quick money. I mean, I'm all about showing you guys the ways to do it. You've got 3 hours a day to trade. I mean, those last hour and a half, hour, I mean, it goes pretty slow. So you'll have time to figure out setups and find ways to apply this and just turn this knowledge into money. And I think that's pretty freaking cool that you can just turn this knowledge into money. So that's the goal here, guys. Let's make bank. Let's crush it. Short butterfly, long butterfly, condor, straddle. You have the tools for multi-leg option setups. And now we're going to transition over to technical analysis and look at really applying these stocks. I'm pretty excited about it. Yeah, there's just a couple other things we'll go through, and then we'll get it going. So thank you so much, guys. I really appreciate it, and I will see you in the next module. Woo! Thanks.